Real estate or the stock market, the debate that will never end. The stock market investors will always point out how great the stock market is, such as the unbelievable rate of return you could have within the single year, while the real estate investors will point out the cash flow that the real estate provides. Each of these groups is right, but both real estate and the stock markets have their pros and cons. And the truth is somewhere in the middle, as always. If you are a stock trader investors in 2020, it doesn't matter what stocks you invest in. You most probably made an incredible rate of return. If you had invested in the tech companies, you probably doubled or tripled your money within a year. And if you were the real estate investors, you probably didn't do much. Property price increased by around 12%. That's nothing compared to how much the stock market rose, but in the context of the real estate, 12% is a lot because the real estate market usually grows by 2 or 3% at best. So let's try to find where should you invest your money this year. Is the stock market better than the real estate, or is the real estate is the greatest investment you can ever make? If you have the $50,000 or $100,000 that you saved up, where should you invest in? We will answer all of the questions and many more, but before we do that, make sure you give this video the thumbs up for the YouTube algorithms, and let's get right into it. Real estate versus stock market. When you buy the stocks, it's just the digital document on the screen of your smartphone. You almost have no control over it, since your single stocks isn't going to give you much influence when the company has another 5 or 10 billion stocks. While real estates give you the complete control over your investments. Even if you have taken a mortgage to purchase it, you can touch it, feel it, and control it. What sets real estates apart from the other types of investments is the leverage. With $50,000, you can control $50,000 worth of the stocks, but when it comes to real estates with $50,000, you can control $500,000 worth of the real estates. I'm a big fan of the stocks market. I spend hours every day looking at the charts and numbers of the reading reports to find the good investments, but you have very little leverage of the stocks market. Of course, there is something called margin investing, where you can borrow from your broker firm or double or triple your income from the trade, but it's not as much as real estates. On the top of that, margin accounts are usually used to the trading and not investing, since the interest you have to pay on the borrowed money is pretty high. While in the real estates, you can get the decent mortgage rate for the 30 years, especially now. We also have to consider the cash flow. Have you ever heard the term the king of dividends? There are the companies that are within the S&P 500 that have been increasing their dividends for the past 50 years or more. Think about it. 50 years is a long time. Booms and busts, inflation and deflations, high interest rates and low interest rates. These companies have survived and prospered through it all and keep raising their dividends rates year after year. One such company is the Johnson & Johnson. Guess how much dividends does it pay? It's a little over 2.5%. Besides, the stock price did not even increase by 50% in the last 5 years. While when it comes to the real estates, you can get 7, 8 or 10%. It all depends on the neighborhood and the property. So if cash flow is more important to you, then real estates is the options to go with. But the problem with the real estates is it's nearly impossible to have such high growth like you could have in the stock market. Unless it's a bubble. Sometimes a company enters the game and revolutionizes the entire industry, and a $10 or $20,000 investment in that company could worth millions in less than a decade. Netflix is the great example, but it's just one out of many. Netflix stock's price since 2012 rose by over 5,700%, which means every $1,000 that we invested in Netflix back then now worth $57,000. In or other words, if you invested just $18,000 in Netflix 2012 without doing anything else, you would have become the millionaire today. The stocks market is filled with such examples. When it comes to growth, the stocks market undoubtedly wins. But if you are not emotionally stable, then the stock market isn't for you. The market jumps ups and downs every single minute. Sometimes it's all over the roof, rising like there is no tomorrow, and if you can't control yourself, you will start buying more when you shouldn't, since that plunge will be followed by the corrections. And vice versa, when the stock is falling for the few days in a row, you have to understand that it's temporary and be patient. But what I do like the most about the stocks market is that when you invest in a certain company, especially if it's a safe investment in a huge company like Apple, you don't feel like you own something. I mean, of course, theoretically, you are one of the owners of the company, but how much your 10,000, 20,000, or $100,000 investments in the company really worth? How much real wealth does it provide you when the company worth over $2 trillion, while when it comes to the real estate, you own the entire things? What we also have to consider are taxes. If you make $1 million and the government take half of that, such as in the case of the income tax, then you are not making $1 million, and that's where the real estate also wins over the stocks markets. When your stocks rises in value, remember that you are the only getting wealthier on paper. If you want that wealth to turn into the real money and you can spend on yourself or buy another assets, then you have to sell your stocks and pay the capital gain tax, which is 20% for the long-term investments and can go as high as 37% for the short-term trades. With real estate, there are the multiple ways to avoid taxes and use that cash to grow your wealth. For instance, instead of paying for the entire property upfront, you can deduct the portion of your mortgage attributes to invest payments on your taxes return. You can recover the cost of income producing rental property through depreciations. The depreciations expense often results in the net losses on the investment property, even if the property usually produce positive cash flow. These loss are as well as the expenses such as the um, utilities and insurance deducts from the ordinary income. Even if you ended up seeing the horse, you can avoid paying capital gain tax if you purchase another property that's bigger. Tax incentive is real estates are unbelievable. It seems like the real estate investors worth the tax code 2021. Alright, now we know all the ups and downs of both the real estates and the stocks market, and in many ways real estates look quite a good deal. But the question is, what's the best investments now? This year, well, the answer is a bit complicated, but let me simplify it. Real estate's the great investments, especially when the mortgage rates are low. Even a single percentage is going to play the huge difference in the long run. So with the mortgage rates now around 3%, it's definitely one of the best times to take the mortgage. And for the past years or so, everyone who saved up for the down payments did take the mortgage. The Fed was so afraid that the pandemic will stop people from the buying house that it lowered mortgage rates from the almost 5% in 2018 to 2.6% by the end of the 2020. But that's reactions in mortgage rates led many people to take the mortgage to point where home prices rose significantly, as we have discussed in one of the previous videos. Home prices usually rise by 2 or 3% just to match with the inflation. However, in 2020, in the middle of the pandemic, when the most people lost their jobs, home prices rose by 12%. That's why many economics predicts certain corrections. But that's just the predictions because we are not out of this pandemic yet, and the Fed might keep mortgage rates low for another few years. Everyone who couldn't take the mortgage in 2020 will do that this year and in the next few years. So there is a very good chance that the home prices will keep rising for another few years as long as the interest rates are low. The same goes for the stocks market. During the 2020 crash, the Fed stepped in the flooded the market with the cheap money. It started buying the junk bonds and even lent money to largest corporations such as Apple or the Microsoft. Most of those companies should have survived last year, but the Fed chose to inflate the market to prevent deflations. Of course, that's the great, but what happens when the Fed increases interest rates or stops buying corporative bonds? Most of people companies will start suffering. So the market could witness even bigger corrections compared to that we have seen in the last few weeks. But according to the Fed, it plans to keep the interest rates at the bare minimum for a few years until the economy is back on its knees. That's what the Fed plans, but that doesn't mean it's gonna happen. Only time will tell. If you have enjoyed this video, you will most definitely enjoy this custom playlist that I have created specifically for you that has our most popular videos on business, investing and the stocks market that can potentially change your life. And now give this video the thumbs up that it deserves, and make sure to subscribe if you haven't done that yet. Thanks for watching, and until next time.